So today we're going to be talking about the week open red to green pattern, which is great for many reasons because we can apply it to so many different types of stocks. So great pattern for, oftentimes you'll hear me say real stocks, mid caps, large caps, etc., earnings winners, strong stocks in hot sectors. But then the other great thing about it is it's a great day two continuation pattern for speculative penny stocks as well, and I'll explain. So what we're looking for, I'll start with the first one, because a lot of people wonder, they see a strong mid cap, large cap. I mean, this applies to, Nvidia's, Apple's, and even your $15, $20 earnings winners and what we would call like a mid cap, etc. They see them kind of at the end of the day. Like you might be trading penny stocks in the morning, and then you see these stocks closing strong, and you want to buy them, but you're afraid you're going to be buying the top at the end of the day, which is smart. It's actually smart. When you've got this, higher quality, high price stock that's, up 10, 15, 20% on the day, really dangerous to buy it, hoping that it will gap the next day. So let me lay out some of the criteria for the mid and large caps. So what we're looking for, love this for earnings winners, okay? Stocks that have had earnings that morning or perhaps the previous night. Earnings, 99.999% of them are going to come out either after the market close or in the morning. Big catalysts. When I say big catalysts, sometimes that can be a little difficult to explain, but we're talking like substantial, not penny stock catalysts, you'll see penny stock catalysts where we might have a deal with this large company for a lot of money. Like there's no specifics or anything. When I say big catalysts, like real stuff, U.S. government contract, partnership with Apple or something, and there's named partners. It's a real announcement. And then love this pattern for those stocks that are strong all the way through the day. Because again, we're talking mid-price, large caps, etc. They're not going to spike up 100% in minutes like penny stocks do. So then I'm going to kind of define this for the two different setups. And what we're keying off of, so here's we're going to call this the 9:30 open, but also think of it as like midnight as well. So you've got your previous day and then current day. So let's imagine that this stock had earnings or a substantial catalyst early in the morning and really just trended up higher all through the day. Just was gradually trending. You never really got a good dip to buy into. Like that. That's why I like this pattern as well, because a lot of when we're looking to enter position on these swing trades, or again, the mid caps, large caps, you want to get a dip. You don't want to sit there and chase the top all the way up. But a lot of the times you just never get that dip because they just trend up all through the day. So now, if that happens, or maybe you don't see it till the end of the day, you don't get impulsive and you don't buy. You wait for the week open red to green. So now I'm going to denote the blue line. Let's use blue for the PDC. Okay, now that stands for previous day's close. Now that's the 4 p.m. previous day's close. Most of these mid cap, large caps are not particularly active in after hours. If they do move in after hours, it's on very low volume. So I don't really consider it real volume. It's just a few people kind of trading around. You'll see, once the 4 p.m. close, if it is trading, and they do trade it after hours, but you'll just see the liquidity completely go out. So that's where I say it's not really real volume. So we key off of the previous day's close and use that as our guide. So when I say week open, a lot of times people think I'm talking like WEEK. No, it's not based on the weekly chart or any of that. I just say week open, like the price action is weak. It just opens up the next day and kind of trickles lower, which denotes a red move. Okay, so in traditional day trading and swing trading parlance, when we say red to green or green to red, that is keyed off of the 4 p.m. previous day's close. So if a stock gaps down, it's red relative to the previous day close, and you'll see this in your charting platforms. Like you'll see the stock is red 5%. Well, that's based off the PDC. Or if it's up 5%, that's based off the PDC as well. So what we're looking for is that kind of trickle lower post-market open, our week open. Now we don't want like a morning panic here. Okay, this is a different pattern. We simply want a gap down, but not like a massive volume gap down and not a 20% gap down. We're just looking for, and I know I keep repeating, but like a week open. It's just not as strong as it was the previous day. Now you'll see this over and over again with earnings winners on day 2, day 3, day 4, on those big catalyst plays, etc. Then you'll start to see kind of that sideways grind. Then we wait for that resumption of the green move. And now what is happening there is, you went from a momentum to the downside, a lot of sellers coming in, to the momentum flipping when that stock goes green on the day. And what that is it's just a psychological thing. Like there's a lot of people that were in this stock and they're still in it, or there's a lot of people that missed it. They saw it, oh man, Nvidia was up 10% or something. So it's in their consciousness, but then they see the gap down and they're like, oh, I missed it again. But on that green move, what that does is it brings in all of those buyers that either missed it the day before or were waiting for the week open red to green. Now, another attractive thing about this is if you think about this big move the previous day and then that red open, you're going to get some smart short sellers there. They're going to come in and they're going to be like, oh, this stock was up too big yesterday. It got ahead of itself. And a lot of, like when I say smart short sellers, they're just pinpointing profit taking. Like it's not like, I know short selling kind of get this like reputation, like they hate everything, or every stock's going to zero, and you'll see that with the degenerate penny stock people. But when I say the smart money, they just know that, or that they don't know, they have high certainty. I mean, it was up huge the previous day. You're probably just going to get a lot of profit taking. There's a lot of people that bought through the day. They're going to lock in that profit when it gaps down and move on to the next trade. And then shorts are just looking to join that trend. But and a lot of these stocks do kind of sell off on day 2, but we don't care about the ones that sell off. So now you're attracting the shorts, and the smart ones, smart money, they're going to put their stop at that PDC, the previous day's close, because the stock is now green on day 2. You're going to get breakout buyers. You're going to get, people adding from the previous day. Like if you're trading big positions, you're not going to put that whole position on in one day. Now, I know a lot of you guys are new traders, so you're just kind of all in and all out. But if you're trading a bigger line, you might be buying a little bit here and buying a little bit here and looking to add some more the next day and add some more the third day and, build a big position to swing or long-term invest that trade over time. If you're if you're trading a big line, as we say, you're not going to buy 100,000 shares in one block. You're going to build that, 1,000 shares here, 10,000 shares there. You're going to build that position over time. So those people may be adding there. And you've got that resumption of the breakout. So now what we do is we use the 4 p.m. previous day's close for our entry. And then what I like about this, let me change my colors here, is we got a really smart stop, okay? And that stop is the gap down consolidation area. Now that might be 5%, it might be 7%, and at the extreme, maybe 10%, but we're just looking for that small kind of single digit gap down and then sideways price action to build support to then stop off. So now in this scenario, yet again, we can write a trade plan. Our entry is the PDC. Our stop is the morning consolidation. And then, with these, since we're talking mid cap, large caps, earnings winners, etc., we might not have a target right away. That might shock some of you by saying that, but when we're talking about these types of plays, these are our swing trades. So we can use trailing stops on these. We can hold these for days, weeks, and not worry about crazy penny stock moves, etc. And you may just put in a trailing stop and let it win or let it go. If it's trending up, there's no real reason to sell when you're talking higher quality stocks, and you might hold for days and weeks or months looking for that big gain. And if it never pulls back enough to trigger your trailing stop, you just leave it on. If great quote in this scenario when we're trading these types of stocks is, if it does no wrong, stay long. Like, you don't have to worry as much. Now, there is always possibility mid caps and large caps can do dilutions and have news, but it's rare. So you can kind of hold with confidence. And if it's trending up after a red to green, and then it does another red to green the next day and continues to trend, there's no real reason to sell. That's how you capitalize on the massive gains on swing trades, is by just, if it does no wrong, stay long. So that's how we trade the mid cap, large caps. It's very similar with small caps, kind of the same idea. Let me use my blue again. We're still based off of the 4 p.m. PDC. But we're going to approach these a little bit different in that, this is going to be that low price stock, again, small caps, etc., that made that big move and then kind of trickled into the close. So, in this scenario, it's a day 2 continuation pattern, etc. And, a lot of you, I know, part-time traders, so you might see the previous day's massive gainer. Oh, look at this stock up 200-300%. And then you're looking to capitalize on the next day. So what we look for, and I kind of messed up my line. Let me kind of draw it there. So it closed there. Still up big on the day. So it's still up, 50% plus, but it kind of fades into the close. Now, what you're going to see with these, since we're talking small caps, is you're going to see a pretty violent gap down the next day. This is a big reason why, and we'll save this for another video, but a lot of you know I'm famous for saying winners hold winners and losers hold losers. With these momentum stocks, as we head into the close, the trend tends to continue the next day. I know I'm dropping, hopefully you're taking notes, but with these types of momentum trades, invariably the trend continues the next day. And what that means is, and why it ties into winners hold winners and losers hold losers, is if you hold these faders into the close, you're just begging to get caught in the gap down. Since the trend continues the next day, the trend was down, it continues the next day. Now, again, I'll save that for another video. When it comes to holding momentum stocks, penny stocks, small caps, etc., overnight, you want the exact same pattern, because you want that trending up into the close, because if the trend continues the next day, that's the type of trend we want to stay in. It closed strong, odds are it gaps up the next day, you sell, you save a day trade, etc. But with these violent downside ones, you'll see very often this happens, and then right about 9:45, kind of after the market opens, you'll see a big inrush of volume, which pushes that stock. Whoops, I screwed up. That should be a green line. There we go. Pushes that stock green on the day, and much like the mid cap and large cap play, that's our buy. Now, we approach the risk management a little bit different on these. With these, I use what's called the set risk methodology. And what set risk methodology is with this type of pattern, I would recommend just using a dollar amount that you're safe losing, because what happens is the violence of this pattern is so quick that it's difficult to pick a level on the chart to necessarily base your risk off of. So what I like to do and what I recommend is, like, again, for the sake of math, you're buying 1,000 shares and you're basically risking $100 in this scenario. So in that scenario, it pulls back 10 cents, you're stopped off, because failed red to greens tend to fall all the way back really hard. You don't want to wait for that move. So just pick a dollar amount that you're comfortable losing, and then do the math in your head based on the number of shares you have. Don't get over positioned, but like in that scenario, it goes green at, again, let's say $2 a share, falls back to $1.90. You gave it a shot, you shoot your shots in trading, you lost small, the momentum failed, and you just move on. Now, on the vice versa, if you're risking 10 cents a share, or it could be 20 cents, or it could be $1 a share. I mean, this works great for previous day short squeezes, stocks that have gone bananas the previous day and go from 2 to 10 and then close at 8, gap down to 6, go green at 8, and they'll spike $2, $3, $4, $5 or more a share on day 2 because that gap down invited in the short sellers again. So you can have really good risk to reward on this. Like in this scenario, you might have 10 cents a share of downside risking $100, but when they go green, they really go green. And a lot of times you'll kind of test that previous day's highs, which gives you a lot of upside. So this is what I would call a higher risk to reward setup because it is a day 2 continuation play. You can aim for bigger goals than just 3-to-1. You know, we kind of start with 3-to-1 when it comes to day trading penny stocks, but you can aim for bigger goals on a week open red to green, because since it's a day 2 continuation, we're getting validation that there's multi-day ability here, and you don't have to be in and out so quick because it's not what we call a day oneer. A lot of the times with the day oneers, they spike and they die, so we don't aim for big wins. The week open red to green with small caps sets up big wins. So one of my absolute favorite patterns, it's very part-time trader friendly. Like I was a part-time trader for the first 7 or 8 years of my career. And the reality is you're at work, you're traveling, you're picking up your kids. Like you just might not know about a lot of these stocks until evening or the next morning. It's just a reality. Like you're at work, you can't, it's better now. Like back when I got started, didn't have iPhones and Androids. I had a Razor, okay? Good luck looking up charts on a Razor, Motorola Razor. But so I would just find out about so many of these stocks, like when I sat down at my desk at night, and the market's closed. So I really found a lot of success in this pattern because if the stock gaps down and doesn't go green, just ignore it. If it does green, stacks the odds in your favor and sets you up for 2 different scenarios. Great swing trades, multi-day, multi-week holds, let your winners run, use trailing stops, as well as the ability to trade very explosive movers and be ready for them before, in advance, and you don't have to try and chase the day oneers, because chasing day oneers as a part-time trader can be hard. Like, are you in a meeting when it takes off? Are you not in a meeting when it takes off? Okay. Now, if you're not in a meeting, you can nail them, but if you are busy, you might come back and be like, whoa, this stock's already up 100%. The week open red to green allows you to be ready the day before. So let me know in the comments, guys. Have you traded this pattern? Is it the first time you've ever heard of this thing? What were some of the misconceptions? Like when you heard me say week open, did you think it was based on the weekly chart? Give me some comments and let me know. I mean, have you been trading mid caps and large caps? I think so many people leave money on the table because they don't use this pattern. They don't use trailing stops and they don't ride those multi-day, multi-weeks. And are you missing all the day oneers? Well, here's a solution. So when it comes to all of these patterns and setups and all of these things, this is just one of many, many, many patterns that I use and teach in the Daily Income Trader system. It's a mentorship program. It has software, it has scanners, has trade alerts, has all the education you need. We get in depth on the patterns. If you're interested in that kind of education and daily mentoring, hit the link below to check out the Daily Income Trader system.